welcome to Sectors Up Close. I'm Elena Casas. Today, we're zooming in on big tech, and my guest is Keith Gangle, Portfolio Manager at Gradient Investments. Apple, Amazon, Microsoft, Alphabet and Facebook's parent company Meta Platforms have collectively lost about $2.7 trillion in value so far this year. That's about the annual GDP of Britain. That doesn't mean, though, that the companies are feeling bearish. Microsoft has doubled its employees' bonus pool and Google has committed to hiring more engineers. That reflects a belief that some of the FAANG companies are so dominant in their sectors, social media, smartphones, e-commerce, cloud computing and search, that they will be immune to high inflation and even to an economic downturn. Investors, though, clearly feel these growth stocks were overvalued, and with the Fed forecast to raise rates to 3% by the end of the year, they have steeply sold off. This is the Nasdaq, which is down about 26% year to date, but some of the big names have seen much steeper falls. Amazon is down 36% and Meta Platforms down 42%. So, are investors right to get out of big tech? To find out, I'm now joined by Keith Gangle of Gradient Investments. Keith, hi, thanks for joining us. Do you think it's true that these FAANG companies are so dominant in their own space that they are to some degree immune from a possible recession?
No, they're not exactly immune, but they can handle recession better than other companies. So their growth rates are secular growth winners. So in a cyclical downturn, other companies more economically sensitive will slow down, but these secular growth companies, their growth rates remain high. Another thing to think about is if we do have a slowdown in the economic activity, growth becomes more scarce. People are willing to pay up for those, and that's why we like these secular winners, especially these FAANG group.
Does it still make sense to group the FAANG together?
You can group them together, but they all have different drivers, right? Some have technology, some are driven by ad spend, some are driven by search, some are driven by subscription base, others are driven by devices. But what they all have in common is they're all secular growth winners, and they're all leaders in their space, and they continue to innovate and drive performance.
Let's bore down then into some of these individual stocks. Amazon, for example, a huge winner, of course, from the pandemic when we were all stuck at home and ordering deliveries. But since lockdowns have ended around the world, that stock has really suffered, hasn't it, with inflation and supply chain problems. So what exactly is going wrong there?
Yeah, Amazon's actually underperformed last 2 years by about 50%. If you look back historically, that rarely happens. And the main driver for the reason the slowdown on Amazon is their CapEx spend. They've been actually investing in building distribution centers to reduce their delivery times to customers. Ultimately, that's a good thing, but typically during this investment CapEx period, the stock doesn't do very well, but as soon as it's over, the stock does very, very well. We've now come to the end of that cycle, so we expect the stock to do better. Another stumbling block for them has been their hiring. Like you mentioned earlier, they've actually doubled their employment base in the last 2 years. So they actually overhired with a little bit of an economic slowdown here. They have a few too many employees. Actually, last quarter, they had a $6 billion headwind because of extra buildings, more employees, shipping costs. That's actually expected to go down to $4 billion next quarter, and we think that'll continue to improve going forward. So that should be a huge tailwind for them.
Another underperformer recently has been Meta Platforms. Its rebranding last year didn't seem to go down very well with investors. It's facing regulatory challenges on both sides of the Atlantic and losing younger users to TikTok. So does the brand still have any space to grow?
Yeah, we believe it still can grow. This kind of company is fantastic as well. It's obviously got Facebook, it's got Instagram and Reels. So you mentioned some of the issues. Regulatory issues been around for several years. I don't think that's going to go away in the next several years. Now, the valuation is what we look at in this company. The company's growing 14 to 16% on their top line and bottom line. Stock's trading at a 14 multiple. The S&P 500 trades at a 16 multiple. So we think we have higher growth rate, a cheaper multiple. Last quarter, we actually started to see growth again in their DAU, which is daily active users, grew at 1.6%. 2 quarters ago, they were blaming a little bit of a slowdown on TikTok. But we think now with Instagram gaining traction, we have Reels gaining traction. We think there's a good opportunity to buy a secular winner on the discount.
You sound pretty bullish on all of these companies, Keith. Are you advising that investors buy the big tech dip now?
Yeah, we do. We like them a lot. Obviously, they're overvalued going into the year. Now they've actually sold off more than the market, like you mentioned. These stocks are down anywhere from 25 to 50% year to date. Stock market generally is down about 17%, so they're done a lot worse. And most of it's not been because of their EPS coming down. It's been multiple compression. They've now, a lot of these names actually trade cheaper than the overall market. And so we think these names, if you look forward for a couple of years, they will continue to grow. They'll outperform the market. You can buy great companies on sale at this point in time.
Thanks so much for that, Keith Gangle, Portfolio Manager at Gradient Investments. Well, before I go, let's take a look at some of the stories we're following in this space. Snap, once seen as a key rival to Facebook's Instagram, has slashed its quarterly forecast, saying the economy has worsened faster than expected in the last months. The company blamed rising inflation and interest rates and said it would slow hiring for this year. Zoom, meanwhile, raised its full-year profit view when it reported after the bell last night, saying demand from large businesses who are sticking with a hybrid work environment is strong. Its revenue from corporate customers jumped 31% in the first quarter. And Amazon is once again facing questions over its tax affairs. A report in the UK showed its cloud computing business had been awarded $531 million in government contracts in the last 2 years. Annually, that's more than 10 times the amount of corporation tax it paid. That totalled just $27.8 million in 2020. And that's your roundup of the big tech sector. I'm Elena Casas, and this is Reuters.